We've heard a bit about how diverse small caps are, how incredibly large number of stocks is to look at. So what I want to do, or Matt and I want to do together, is give you a lens that we use to actually look through that diverse number of stocks and pick winners. And equally importantly, sort of try to avoid losers. So in many cases, there are bubbles that appear in small caps. Go back a couple of years, the lithium sector was on a huge tear. It got very expensive and then completely imploded. And before that, of course, you had the buy now, pay later space. You had the afterpays, the quad pays, the before pays, the don't ever want to actually pay. And we managed to skip all that hoopla. So how do we do that? I think behind us is a process and a team that actually makes that much easier and much more repeatable. So what do? Well, we've borrowed from the greats, and we focus on free cash flow. I mean, others do this as well, but we think this is absolutely essential to how you should think about investing. When you're investing in a stock, you could be buying a property, you could be buying bonds. So it all comes back down to free cash flow. So we look for businesses that generate free cash flow and screen out those that don't have cash flow. We think about risks a lot. So many of our peers will get up here and talk about how incredibly good they are at picking great stocks. And we're looking for good stocks that give you great returns. But equally, we're focused on trying to avoid the stocks that can cost you a lot of money. And especially days like today, that kind of risk-first focus really helps us out. And then we look for things like balance sheets. We like low gearing, and we think valuations still matter. So even growth stocks, we think, high multiple stocks, should be able to be defended on a fundamental bottom-up basis. So we will not overpay for a growth name. We do own some growth-style stocks, but we make sure that we can justify their valuations fundamentally. And then importantly, and Matt's particularly good at this, is looking for inflection points. So with 200-odd names in the index, another couple hundred in the microcap index, we have to keep an open mind for when things change. And I often say that if you're running a large company like BHP, no disrespect for BHP, of course, but if you're running a behemoth like that, put in a new CEO, changes are very gradual. And it's like wrestling the steering wheel of Queen Mary. It takes many, many years for changes to impact the outcome or the share price. Or in small caps, it's quite different. A new CEO or CFO can make a dramatic difference, selling off assets, buying a new business, cutting costs, etc., and you can see a quick turnaround. So we try to be nimble for that. How does that apply to small caps? Well, we think the process is repeatable. It can apply to cyclicals, turnaround stocks, growth stocks. It's not one stock or one sector we can't apply cash flow lens to. It avoids hyperbolic bubbles. I mentioned two before, lithium and the BNPL space. It's fundamental, and then we are very bottom up. We look at mid-cycle versus spot. And we use all our own internal forecasts, so we don't mind if there's very limited coverage on the sell side. Our team builds models from scratch, from the bottom up, and we base our investment decisions on those.
So process is important, and we think we've got a robust process. We engineered it at the outset to cater for different styles of investing, and there's different ideologies and philosophies in the market, but we can go from value to growth. But what's really important is the people in the business, and Marcus and I have worked together for over 12 years now. We started the business 9 years ago with 3 of us, and over time we've expanded to 9 people. So we've got 9 people now. The product set has expanded from just domestic, 3 products domestically, to adding a global one in 2019. And we are scouring the world. We're out there seeing companies offshore, meeting face-to-face with companies very frequently. So our overseas trips, the volume of trips has picked up. We also do a lot of calls with overseas companies. So we're getting insights from offshore that I think is very synergistic with the domestic business here. In terms of that, if you look offshore, the markets in most cases are more developed than the Aussie market. So you get to see, I guess, where the Aussie market could go in certain industries, and that gives you great insights domestically. In some cases, it goes the other way. So we've got more developed industries, and for example, the property portal market is very advanced here, and in other markets offshore, it's not as advanced. So we do get synergies both ways, and we think it helps, having a global business helps with the domestic business as well.
The valuations also jump out. So we've spoken before a bit about bubbles appearing. So I mentioned lithium, buy now, pay later. But some of the tech names here, whilst they're good businesses, and Matt and I would like to own some of these names at the right prices, we won't pay any price, as I touched on before. And with a lot of money chasing a very narrow space in Australia, you do get incredible bubbles. I'd call out WiseTech here as a name we think is incredibly expensive versus some of the other names you can buy overseas with similar growth rates. And as Matt said, we get some good insights on things like Reece, which is a stock in our index as well. We look at a company called Ferguson in the US, and so we get a really good contrast and comparison with valuations and multiples. And we like Reece. We've been a shareholder in Reece previously, but it bought some assets overseas in the US. It got really re-rated on the back of that acquisition, and some strong earnings momentum in Australia, and we sold it, and it's continued to rally for a while, and then has recently sold off aggressively because it got quite expensive. So that synergy, we think, between domestic and global really helps us garner insights in both directions. Just to highlight that again, another stock which has been very popular. People have probably owned a lot of it in their portfolios in the room and have made a fortune. Congratulations to you guys. We looked at this stock a couple of years ago, and we think it ticks a lot of the Spheria process boxes. So on the left-hand side, you can see that classic chart we put up showing a reconciliation of cash flow versus EBIT. So we like to check the cash flow and the balance sheet and P&L all tie up together. So businesses like this, where cash flow reconciles well, would meet our process. Balance sheet's very good, but the multiple this stock got to was truly eye-watering. It got to not only 200 times earnings, it was over 100 times revenue, which I would challenge most people to find a stock like that anywhere in the world growing at 20 to 30% a year. So good business, just got very expensive, we think, because of an incredibly narrow market chasing a growth name. I've touched on WiseTech as well, so I won't repeat that one. But again, another name where we just felt like the market was running narrowly into a growth style name, and paying scant regard to sort of fundamentals and valuations.
In terms of the global market and our global portfolio, our biggest holding at the moment is a company called Car Gurus. And so its equivalent is car sales here. And if you look at that chart on the right there, you can see that the actual car sales multiple is nearly double Car Gurus, but you're getting potentially a better business in the US at half the multiple. And the reason for that, and going back to, I was talking about more developed markets, is the actual Aussie online marketplace for used cars is more developed. There's only one player left in the market, and that's car sales. In the US, you've got 3 players. The dealers are the biggest customers for Car Gurus, and they currently use on average 2.5 dealers. So there's basically 3 players in the market. We think over time that 3 will go to 2. So it'll become a duopoly market, which is a pretty attractive market. And potentially over time, it could gravitate towards a one-player market. If it's a one-player market, it's a monopoly market. The current market cap of Car Gurus in the US is $5 billion. The market cap of car sales here is $12 billion. So it's not an apples for apples comparison, but the actual US market is 10 times the size of the Aussie market. So when you get those sort of perspectives on a company, you can see that Car Gurus could be a lot bigger down the track, particularly if that market does morph into a monopoly market. Supply Networks, just stay on the auto theme, is our biggest holding domestically. We've owned it since it was a nano cap company, so we found it when it was very small. It grew into a micro cap company, and it's grown into a small cap company over the years. All the growth for Supply Network, and we've spoken about this many times, has been organic growth. So these guys basically dominate the bus and truck part market in Australia and New Zealand. They've got about 15% market share. They supply independent mechanics. Independent mechanics are about 40% of the market, but independent mechanics are taking market share from OEM mechanics, so they're winning share in the market. So their customers are growing. The actual part market is growing. You can imagine the complexity of the trucks and buses in the market and the complexity of the spare parts. So the business is growing organically. You can see it's had 15% compound growth over the past 10 years. The salient points from the first half result, the first point is in the first half they earned $171 million of revenue. If you go back to 2021, they did $170 million in that full year. So basically if you annualise the first half revenue, they're going to do basically double what they did in 2021. That's all organic growth. So they're winning share in that independent mechanic space, and the independent mechanics are growing. When they invest in the business, they're getting a 50% return on every dollar invested. So it's an incredible growth story in this market. We think over the next 5 years, this company can continue to grow. Its customers are going to continue to grow. We think it's the best company in the market that you've never heard of.
And just quickly touching on the current market environment, you've heard a bit about this, and as you all are pretty much advisors, you would know large has outperformed materially the small and micro cap. But it's really stark, I think, in Australia. The 4 lines here represent the large cap index in dark, the mid cap, and then small and micros. Literally, as you go down the spectrum, the underperformance has been bigger. What's driven that? A bunch of reasons we think. People going to defensive names, liquid names. Coverage has dropped off, I think, in micros and smalls. And they're probably more economically sensitive than large cap names, which has meant they've been sold off. But we're actually finding more and more ideas in microcaps. So as you go down the spectrum, as you'd expect, that inefficiency gets bigger, and we're finding actually more compelling names as you go down into the small cap space. This is a PE multiple chart, just showing you the world MSCI index on a PE basis compared to the world small cap index on a PE basis, which we found the best sort of long-term comparison. This is a 15-year chart. So on that basis, if you think charts tell you anything, it does seem like on a relative basis, smalls have been left behind to the extent where they're now looking very attractive.
So the domestic business has evolved over time. We are now running 1.8 billion domestically. That means we do have some bigger positions in companies, and that does mean we can leverage those positions with the board and management. So, where we've got an underperforming company, we generally try and engage with the board and management. It usually means that the company's usually a decent company, so the bones are good. Probably the worst house on the best street kind of scenario. But we engage with the board and management where we think there's capital allocation issues or efficiency issues in the business. And occasionally, we've had to intervene. And more recently, we've had, significant engagement with NZME, Deterra, and IGO. If you go back 2 years, we had significant engagement with a company called Bravura. You can see this chart here. So the stock, fell precipitously. We didn't own it until, near the bottom where we recapped the business at about 40 cents, and we bought about 15% of the company. We were approached by another shareholder in the business out of Canada called Pine Tree, and they wanted us to help basically refresh the board and management team. We went through that process. We added a chair and a CEO to the business that we had history with at another company who we thought were really good. And the company has since rallied from 40 cents to $2.60. So you've made 500% return on that intervention that we did. And so we can see that there's actually a runway to do this more frequently with companies. And I think it is a bit of it's something that we should get involved with, especially where we are more sizable in our holdings in the companies.
And then look, a quick ad just to finish off. No presentation will be complete without an advertisement for Spheria. But both our small caps and our domestically and globally, our small cap funds have actually outperformed since inception, as was flagged earlier on. But equally, I think those performance tables are a little bit sort of one-dimensional. I don't know if you guys feel this, but there's one dimension just mentioning alpha. The other factor that's not mentioned typically in those tables is risk. And then, of course, there's other things like tax consequences and everything else. But we feel that we are a low turnover fund typically versus some of our peers. And the risk we've taken on to get that alpha is materially lower than the index, with the beta and the volatility being much lower, both domestically and internationally, over the last, this is a 12-month number, but if you go back every single year, we've typically had lower volatility than the marketplace. So we're quite proud of the fact that we've got good alpha with perceptibly lower risk.
Yeah, look, we're classic investors. We're looking for free cash flow generative businesses. We're looking for sustainable cash flow, but valuations do matter for us. So we're not going to go out there and buy a great company at the wrong price. We also are obviously implementing more engagement with companies, and we think that can add value over time. We discussed that. We think there are some true growth companies out there. I mentioned one, SNL. We're not happy to pay more, but we will pay more when we think there is a true growth company. We think there are companies here that are labelled growth companies that probably are not. And if you wind back a few years, you had Domino's Pizzas, which we think was misunderstood by the market. We've invested in the business and the team. Obviously, we're doing a lot more offshore travel, which I think is conducive for the domestic business and also helps our global business. And the most important thing is the market has become very inefficient down the market cap spectrum. You've seen industry funds go up into bigger stocks. You've got passive money going up into bigger stocks. And the small caps and micro caps have really dropped off the radar. So we think where that inefficiency is where you can make the money going forward. Thank you.
Thank you.